Here to share his outlook on the market and where he sees opportunity is Jose Rasco, Chief Investment Officer at HSBC Global Private Banking and Wealth. Great to have you back on the show, and that's exactly where I'm going to start with you. In a market where, as we were having this conversation earlier in the hour, you could argue that it's priced to perfection. Is that how you see it, or is there opportunity here in equities specifically?
Well, we think there's opportunities longer term, and no question, the fundamentals still look very supportive for U.S. equities. But in the short term, yeah, we think the market has priced in too many Fed rate cuts and too quickly. And we still think that there's going to be a repricing of earnings expectations this year. And once we get through that, we think the longer term fundamentals are going to make a lot of sense. And as the Fed begins to move, we think they're going to move and begin to cut rates in the second quarter. As they begin that journey, that we can price that fully into the market. And I think the market has a lot of upside.
Okay, so would you be buying equities now, or would you be waiting for a pullback? And if you would be waiting for a pullback, where else would you be putting money to work right now?
Well, our number one overweight globally is fixed income, where we think, we've seen the peak in policy rates in most major developed markets for sure, and many emerging markets as well. So if you've seen the peak in policy rates, you've probably seen the peak in market rates. And with continued disinflation, that seems like a pretty good bet. So, returns on fixed income should be pretty solid. That's something we're focused on with clients, is locking in those longer term yields while they can still get them. That's number one. Number two, in terms of equities, the U.S. is still our number one overweight, no question about it. And the way I would look at that is wait for what we think is going to be a bit of a consolidation here, but there are certainly opportunities to dollar cost average your way into better positions on stocks that have not performed up to the pace of the rest of the market. And so there are opportunities out there from the broader market perspective. We think, hold off and wait for that consolidation. And we think coming pretty quickly.
Jose, a lot of investors, retail investors, have gotten used to portfolios that are less traditionally balanced, not 60-40, more weighted toward equities. You're overweight bonds right now, and I wonder how you're thinking about that peak in policy rates and how much investors should be perhaps running to catch up with what was more traditional balance, and how much maybe people just need to stay in more risk in these days where things like artificial intelligence are seeing some massive growth for certain companies.
Yeah, it depends on your risk tolerance, obviously. If you're going to be a balanced investor, globally diversified, then you want to increase your weight in fixed income, which probably got skewed out of balance. So that's something, and this is a great opportunity to do that as yields have in fact backed up. And while we've rallied of the last couple of months, market volatility is going to remain because inflation, we think, in the next couple of months is going to be spotty as we head toward the spring. Food, energy prices could cause a lot of bouncing up and down in terms of the inflation data in the U.S. and abroad. And therefore, that's going to give us a lot of volatility in fixed income, which is going to generate opportunities for investors to go in and acquire those assets.
So is it mostly okay? Is it mostly for the yield long term then, and locking that in now, or how much of it is based on that expectation that because we are where we are policy wise, you're not going to lose that much on just the price side either?
No, we think the yields make sense, and as prices go up and yields go down, we think there's total return that's worthy of consideration in fixed income, no question about it. And if you are a less risk averse investor, equities make a lot of sense to us in two parts of the world. Number one, the U.S. and Mexico, we think that relationship is very strong. And remember, one of the things everybody's focused on is the cyclical unwind due to higher interest rates, right? And that's about to reverse itself over the next couple of months as the Fed begins to cut. The other side of this is secular forces. And those secular forces, we have four major themes I continue to harp on. The tech revolution is just beginning, innovation in tech, nearshoring, onshoring, and the reindustrialization of the U.S. I still focus on those major tailwinds for the U.S. economy that I think if you're less risk averse and if you like equities, great time to look at where we are from a long-term perspective.